Welcome to BizIntel, your weekly briefing to look back at the key shifts in the global economy and technology over the past week. Last week, we talked about a quiet but weighty turning point, AI entering the machinery of the state and beginning to rewrite processes that once felt almost untouchable. When governments, typically seen as slow and conservative, start adopting AI faster than most people expected, it sends a shock through the entire market. And this week, big tech companies are beginning to respond. There are no loud declarations, no grand product shows, but through a series of small decisions, you can see them adjusting so they don't fall behind in this new power landscape shaped by AI. When the market starts examining itself. This week, OpenAI has shifted into a more defensive yet accelerated mode. Google is trying to extend its reach with unusually unconventional strategies. Amazon is tightening control over data and user behavior to protect its advantage. These moves may look separate on the surface, but together they reveal the same pattern. The market is defending itself, rearranging positions, and trying to hold on to what it considers non-negotiable. Once you put all these pieces together, a clearer story emerges. This is no longer just a race to build the fastest technology. It's a struggle to keep a role in a world where AI is no longer confined to labs. It has entered the state, the enterprise, and the everyday decisions of individual users. We'll peel back each layer of these shifts to see what is really moving beneath the surface. Big companies are changing strategy. After the public sector showed it could deploy AI faster than expected, this week the major tech corporations moved into a more visible phase of strategic adjustment, not with big, flashy announcements, but through a series of small changes that quietly set long-term direction. These moves suggest big tech is reassessing its place in a landscape where it understands that the speed and impact of AI are no longer determined by them alone. OpenAI is the company drawing the most attention. Various signals suggest it has entered a phase of internal acceleration with greater intensity than before. Development cycles for new models are being shortened, testing cadence increased, and efforts to push out upgraded versions are being tightened. Even though OpenAI still holds an important position in the market, these changes reflect an awareness that the technological gap is no longer as wide as it once was. As competitors' models improve and the public sector starts rolling out AI in real systems, OpenAI can't afford to move at a steady, comfortable pace anymore. At the same time, the company is facing new demands from governments and large enterprises. They don't just need powerful models, they need transparency, stability, and the ability to deploy at scale. That is forcing OpenAI to expand its research focus into reliability, reducing errors, increasing robustness, and making its systems usable in sectors with strict requirements. This marks an important shift. OpenAI is no longer focused solely on being more capable, but also on being more trustworthy. While OpenAI speeds up, Google is moving in a different but complementary direction, consolidating its position in infrastructure. This week, Google continued rolling out its AI-specialized processors into the data centers of major enterprises. What stands out is that the company is going beyond its traditional ecosystem of partners. This approach allows Google to embed itself in the operational layer that many companies depend on when deploying AI at scale. If OpenAI is focused on the output, models, and applications, Google is investing in the input layer for the whole ecosystem. By being present in the infrastructure tier, Google lowers its reliance on winning the end product race. Whether its models end up stronger or weaker than competitors, enterprises will still need the operational technology that Google provides. This is a strategic move to secure a long-term position in the AI value chain, particularly as more businesses and governments start integrating AI into their core operations. Another notable shift comes from Amazon Web Services, AWS. For years, AWS has followed a closed philosophy, encourage customers to build and run everything inside its environment. But this week, AWS made a meaningful adjustment. It broadened its support for multi-platform deployments, allowing enterprises to use multiple infrastructure providers at the same time. The reasoning behind this is quite clear. As AI is adopted in the public sector, demand is rising for flexible systems that avoid dependence on a single vendor. Government agencies, in particular, want a kind of risk hedging, distributing data, and workloads across multiple platforms. AWS understands that if it clings to a fully closed mindset, it risks losing a large group of customers who are now leading the AI adoption wave. This shift is not just about keeping market share. It's about ensuring AWS remains a first choice for national-scale digital transformation projects. In the same vein, Anthropic, the developer behind Claude, completed an acquisition of Bun, a foundational technology that helps run AI applications. The deal may not be large in dollar terms, but its strategic meaning is significant. Bun gives Anthropic more control over how AI workloads are processed and distributed, reducing dependency on third-party technologies. It's a step toward ensuring Claude is not only strong on paper, but also operationally stable and seamless when used by enterprises and government organizations. This deal also reflects a deeper reality. The AI competition isn't just about models, it's about control over the operational chain. Whoever owns their underlying runtime and infrastructure reduces risk when scaling up or when market strategies shift. Taken together, this week's moves show that big tech is re-examining its strategic architecture. OpenAI is reclaiming speed and shoring up model reliability. Google is expanding its influence in the infrastructure layer to lock in long-term relevance. AWS is loosening its closed stance to stay ahead in a multi-platform world. Anthropic is strengthening its autonomy by acquiring core infrastructure technology. Their motivations differ, but they share a common realization. The competitive environment has changed. No one is the absolute center anymore. As the public sector deploys AI faster than anticipated, big tech is being forced to adapt to avoid losing its place in an ecosystem that is rapidly widening and diversifying. The changes this week do not cause dramatic market swings, but they are clear signals that the AI race is entering a more strategic phase, where each adjustment carries long-term implications. Why is the market becoming cautious? Alongside these strategic recalibrations from big tech companies, this week also saw a notable shift on the user side and among user-facing platforms. Where AI used to be seen mainly as a helper tool, it is now visibly changing how people search, shop, create content, and make everyday decisions. That shift is putting new pressure on major commerce and creative platforms, forcing them to re-examine their operating models so they don't lose the intermediary role that has been their advantage for years. The clearest example comes from Amazon. Over the past week, the company has tightened access to product data and user behavior on its platform, especially for automated tools powered by AI. Amazon has realized that many external AI systems are starting to scrape data from its platform to generate direct product recommendations for users. In practical terms, this means Amazon risks being bypassed as the gateway to shopping behavior, a position it has held for more than a decade. When an AI tool can answer, "What should I buy?" before a user even opens the Amazon app, control over consumer behavior begins to shift. Amazon cannot allow that to happen. Restricting access to data is not just about protecting its ad business or internal search revenue. It is about defending its core role, shaping the shopping choices of hundreds of millions of people. This is a defensive move with deep strategic intent, driven by the fact that AI is not merely answering questions, it is reshaping how users approach information and decisions. In parallel, Amazon is retesting ultra-fast delivery services, aiming to bring delivery times down to within tens of minutes. While this might look like a purely operational push, it actually reflects a change in how Amazon views competition. When users rely on AI to decide what to buy, Amazon's advantage is no longer just inventory or price. It's speed and convenience, the part of the value chain AI can't replace. In other words, if AI captures the decision phase of shopping, Amazon aims to dominate the "how fast can I get it" phase, using that as a strong enough differentiator to maintain customer loyalty. This shift in behavior is not limited to e-commerce. In the creative space, Adobe released data showing that users are increasingly leaning on AI tools to generate images, edit content, and develop ideas. This opens up huge opportunities for Adobe as demand for AI-enabled tools surges, but it also brings serious risks. When AI can produce a flood of content in seconds, the line between truly creative work and generic output grows blurry. Adobe has warned that without careful control, the market could become saturated with lookalike content, eroding the perceived value of manual, high-effort creativity. Creative platforms are no longer just worried about users using AI. They are worried about AI becoming the first place users turn to when starting a project. When questions like, "What should I design?" or "Give me some ideas," are asked to an AI assistant before a user opens a creative app, the platform's role as the starting point of creativity weakens. That's why Adobe and similar platforms are trying to embed AI deeper into their own ecosystems, so that users stay within their platforms instead of drifting toward third-party assistants. Meanwhile, Shopify has seen a clear increase in AI-assisted search sessions. Users no longer browse from page to find products. They ask AI and receive direct recommendations. That forces Shopify to reconsider how it surfaces products. Recommendations, categories, featured images, all the core mechanisms that help sellers reach customers can be skipped over by AI, reducing the impact of Shopify's own discovery system. The company has to find ways to integrate AI into its native search and browsing flows so it doesn't get pushed out of the shopping journey. This shift in user behavior is also creating new challenges for marketing. As AI is used to generate content, optimize ads, and analyze user behavior, ad platforms are under pressure to create recognition and control mechanisms so campaigns are not overrun by automated content. This is meant to prevent advertising from becoming distorted or homogenized, and to protect businesses from wasting budget on ineffective or low-quality traffic. In short, changing user behavior is forcing large platforms to rewire their operations. AI is no longer just a tool that saves users time. It is becoming the starting point of many important decisions. When the starting point changes, control over the market changes with it. Commerce and creative platforms that have relied on controlling the front door to user behavior are realizing they must move faster in response to this new intermediary layer created by AI. That is why this week we see a wave of adjustments from Amazon, Adobe, Shopify, and others. They are not just optimizing products, they are defending their central role in user journeys. Looking at the current landscape, one thing is clear. As AI rewires how people approach information, every platform that depends on traffic flow and entry points will have to rethink its strategy. This is not just cautious behavior, it is the opening phase of a new adaptation cycle, one in which speed, data, and the ability to keep users engaged become matters of survival. Where is power tilting? While large companies are recalibrating strategy and users are changing behavior, this week also revealed a deeper shift, a redistribution of power across the entire AI value chain. This is not about individual companies, but about structural layers that determine who holds long-term advantage and who is easily replaced. From a market perspective, three key zones are becoming focal points, and it is around these three that power is starting to realign. The first zone is the data and input standardization layer. Here, organizations holding structured, historical, high-reliability datasets are gaining renewed leverage. The early phase of AI was fueled by models trained on massive open datasets. Today, however, demand is rising for high-quality data in fields like healthcare, finance, law, and public administration. Those who own such datasets become irreplaceable foundations because no model can stand in for the accuracy and trustworthiness of original, curated data. As governments and regulators push to build common data repositories, this layer is turning into a new anchor of power. Models can change, but standardized, verified data has far more staying power. The second zone is the deployment and integration layer, where the real power lies with organizations that can make AI work in production, not just in prototypes. This is where many companies once paid less attention, but it is becoming critical as governments and large enterprises roll out AI in high-risk domains. To make AI run in a live environment, you need compatible infrastructure, security processes, testing standards, audit and logging, and error monitoring systems. These demands depend less on model strength and more on the integrator's capability. Players who control this layer are becoming mandatory partners across the AI ecosystem. The third zone, the least discussed but increasingly important, is the coordination and governance layer. The bodies that define standards, safety norms, transparency requirements, and rules for AI operation. As more countries experiment with automated administrative systems, there is growing need for shared standards. Which models are allowed, which data is permitted for training, acceptable error thresholds, which systems must log decision histories, and more. Those able to define these standards, from regulators to influential research institutes, hold a new form of power. The power to shape the framework the entire market must operate within. These three zones together highlight a clear shift. Power is moving away from those who merely own the largest models or the most advanced algorithms. It is tilting toward the mandatory points of the system, places that everyone must pass through to deploy AI in the real world, regardless of who leads in pure technology. In that context, having a strong model is just one part of the advantage. The rest lies in who controls the data, who controls the deployment pipeline, and who controls the standards by which safety and reliability are judged. This explains why many organizations are shifting focus from who launches first to who occupies an irreplaceable role in the operating chain. A model can be overtaken, but a data standard, an integration infrastructure, or a safety framework can remain in place for years, even decades. Seen in the larger picture, this week makes it clearer that the AI race is moving into a new phase, one where value comes less from attracting attention and more from making the entire ecosystem depend on you to function. How big is the upside, and how serious are the risks? This week also brought an important shift at the market level. Investors and financial institutions are reassessing their expectations for AI. We are no longer in a phase where any company with AI in its pitch can attract capital. Instead, the market is clearly differentiating between businesses with real value and newcomers that haven't proved their business model. This sobriety is a sign that AI is entering a more mature cycle. Opportunity remains large, but the risks are now in sharper focus. One notable development is the more cautious stance towards stablecoins, assets often seen as a bridge between the crypto world and traditional finance. Over recent months, stablecoins have grown rapidly on the back of trading and storage demand, but their scale is starting to raise concerns. New research warns that oversized stablecoin markets could create spillover risks for government bond markets, since much of the collateral backing them is held in short-term debt instruments. If a major stablecoin were to lose its peg, the shock could spread into traditional financial markets, disrupting liquidity. Even though no such collapse has happened yet, the fact that financial regulators are issuing warnings signals that markets are now viewing AI-related and automation-linked innovations through a systemic risk lens. This has prompted many institutional investors to reassess how much AI-linked exposure they are comfortable holding in their portfolios. In the corporate space, Zoom offers a clear example of the market's new filtering process. Unlike many high-growth tech firms that struggle with profitability, Zoom reported strong financial performance with solid margins and robust cash generation. That has made the company a potential acquisition target for larger groups looking to expand their ecosystems or strengthen their enterprise services. This shows that investors are prioritizing firms with resilient fundamentals, not just those promising AI-driven disruption. By contrast, several AI startups, even those with eye-catching demos, are finding it harder to raise funds. Investors are no longer satisfied with flashy prototypes or aggressive growth projections. They now want proof of scalability, predictable operating costs, and a clear view of dependency on major infrastructure providers. As a result, many startups are revising business plans, shrinking teams, or delaying market expansion. Caution is also rising among large technology funds. Many of them published risk assessment reports this week, detailing factors that could destabilize the AI market: rising infrastructure costs, competitive pressure from big tech, regulatory tightening, and changing user behavior. A common thread in these reports is the conclusion that the buy at any price phase is over. Now it's about select based on real value. This growing caution is also visible in how enterprises evaluate AI solutions. Despite loud marketing, investors and buyers are asking whether these tools actually save costs or simply add new layers of expense for infrastructure, security, and training. Companies that can demonstrate long-term value, for example, by automating processes, cutting decision time, or improving data safety, still attract capital. Those whose promises are vague or hard to measure are starting to fall away. Against that backdrop, another group of companies is rising in prominence: those that provide supporting infrastructure for AI deployment, data management, testing, error monitoring, or system integration. These businesses may not be as visible as the model builders, but they have a strong advantage: necessity. As more organizations deploy AI in live environments, they are forced to rely on partners who can keep systems stable, safe, and compliant. This group is expected to benefit from the market's more sober phase because they offer long-term, less volatile value. Another trend is the increasing caution among traditional enterprises when considering AI adoption. Rather than chasing large, complex projects, many are starting with smaller, lower-risk, easier-to-measure initiatives. They prioritize AI applications with clear direct impact on productivity or cost instead of following hype. This is driving up demand for smaller, easier-to-deploy, and more affordable models. It's also a sign that the AI market is stratifying. Not everyone needs the biggest model. They just need the one that fits. Taken together, this week's developments show that the market is recalibrating its expectations for AI. Enthusiasm is still there, but it's no longer uncritical or universal. The opportunity remains huge, but it increasingly belongs to companies with solid foundations, practical products, and business models that can stand on their own without relying on endless hot money. This sobriety is not a negative signal. It's a sign of a market growing up. As the initial fever cools, the true value of AI becomes easier to see, and the companies capable of creating durable value will stand out. This is the phase where both investors and businesses must answer a harder question. What is the biggest risk, and which opportunities are truly worth pursuing now that AI is becoming part of the economic fabric, not just the latest shiny technology? The market's sober phase begins. This week did not bring explosive headlines, but it revealed a quiet change in how the market perceives AI. After the public sector demonstrated the ability to deploy AI quickly and effectively, major companies began adjusting their strategies while the broader market shifted into a more defensive stance, paying greater attention to risks that could spill over into finance and consumer behavior. These developments suggest that AI is entering a new stage. This is no longer just a race to launch new models. It is the phase where organizations must define their roles within a more complex ecosystem, one where irreplaceable positions matter more than raw speed and where stability matters as much as opportunity. The picture this week is therefore directional for the period ahead. As companies adjust, investors reassess, and users alter their habits, the market will keep restructuring itself in ways that are not noisy but deeply consequential. BizIntel will continue to follow and synthesize these movements to offer a calm, grounded perspective on the changes unfolding around us.